All right. Good Thursday afternoon, traders, investors, Finom Group members, our YouTube audience. It is Thursday, April 21st. I am Seth Golden. Now, I am, as usual, your host here at our weekly State of the Market. Let's check in really quickly. It is Thursday, and unfortunately, Thursdays have not been good to the markets. Our State of the Market day has not been good to the markets either. And once again, today, we are seeing the very same picture, where the markets are, in fact, reversing their early morning rally off of the Tesla reported results. In fact, Tesla itself, as you can see on my screen, 1,095, I think, in the first half hour of trading. It's now $1,020, signaling that, indeed, investors were selling into that rally for one reason or another. I'm not a Tesla bull. I'm not a bear either. I just kind of stay away from it because, it doesn't trade on fundamentals that I can recognize so far as valuation is concerned, so I stay away from it. Having said that, I will laud the company for several quarters in a row, several successive quarters in a row of very sound operational achievements. With that said, let's dig into our weekly State of the Market. Maybe we'll be in better shape by the time we're done, so far as the major averages are concerned. In this environment where, from one day to the next, we have big up days, we have big down days. The VIX is still above 20, and every time it seems to get down to 20, as it was this morning, just below 20 in the 19s, we see selling pressure come into the market. We see volatility once again spike. It's been a consistent theme here in 2022 as we continue through this consolidation phase. So you see a lot of folks hedging frequently. Unfortunately, it's kind of a timing thing this year. And in general, if you're hedging, you're doing some kind of timing exercise because you're fearful of downside risk. So as you can see here on my screen, this is kind of why I don't like hedges. And there's no real logic to hedging, quite frankly. The best hedges, if you're going to hedge, the best hedges are cash and time, which they work in tandem. The more cash you have, the more time you have. The answer to fear of downside risk is not opening a new position or hedge. There is simply no logic in such an exercise when fear of downside risk or losses is the premise. Risk of taxing one's portfolio gains increase with a hedge. If you don't time that hedge properly, you don't get in at the right price, you don't get out at the right price, you essentially have taxed your portfolio on the year. But the risk of taxation is non-existent with cash. Simply buy the dips as the market will eventually rebound toward new highs. I'm speaking about index ETFs, of course, if we're talking about the market going to new highs. That same cash that you used to potentially tax your portfolio because you thought, I'm afraid of the downside, but I'll open a new position called a hedge and I'll be able to manage that in a state of fear of downside risk. Again, there's really no logic to hedging. There's no logic that usurps simply having cash and buying dips, giving yourself more time. Year to date, what's working? Well, not much, but energy, staples, low volatility, high dividend stocks, utilities, and just low volatility altogether. Discretionary, down on the year, communication services, high beta stocks, which are associated with growth, NASDAQ, FANMAG, if you will, growth stocks, and information technology. Those are all down on the year. The defensives are leading, the cyclicals, the offensives are lagging this year. Why are you hedging? I get it, but still, the S&P 500 has nearly erased March's gains so far this month. We're down a good 3%, but there are winners among sectors and factors, as you can see. Energy's in the lead on back of continued gains in natural gas, while defensive segments, consumer staples and low volatility, high dividend, they're up 3%, give or take. Investors have remained defensive in 2022, as fear of higher rates, high inflation, which we'll talk about, of course, and a midterm election compress the S&P 500 PE multiple. So keep in mind, this is normal to be expected market operations. We have higher rates, we have higher inflation. You know, we're coming off of 3 very solid years of S&P 500 gains. We didn't have a 10% correction, since the March 2020 bottom. Like eventually the market does have some kind of mean reversion, especially when you pile on the circumstances that I just outlined so far as Fed rate hike regime, higher inflation, and of course, the midterm election seasonality. Having said that, and again, looking at what works in this environment, well, double-digit returns for consumer staples, double-digit returns for healthcare, which we like also, utilities, and real estate. That's what works in this environment. Walmart, look at Verizon again, folks. Verizon is once again, it went back to 55 after consolidating the first move to $55. Within 2 weeks, it's right back up and higher than it was when it initially hit $55 a share just a couple of weeks ago, 3 weeks ago. Now it's back to that. Telcos do good in this environment. They're kind of a sub-industry of utilities, if you will. What happened there? All right, we got our short UVXY trade completed. Real time. We did this last week as well, folks. So good on us. This is our second UVXY short completed here on the day, actually, for our Finom Group trading members. And if you're not a Finom Group premium member, sign up, folks. Join us. There's money to be made in a down market, in an up market. Yeah, we're probably going to make more, but in a down market, there's still money to be made. There's always opportunity. You give yourself the opportunity by being flexible, having cash on the sidelines, and looking to be in the right areas of the market. All right, so we've recognized that 2022 is likely going to be what I prefer to call a setup year. Others might call it a consolidation year. Again, the previous 2-year period, folks, we had substantial gains. These are all the years where you had a prior 2-year return that is greater than 20% or so, except for 1994. It's the only one where the prior 2-year period was under 20%. But as you can see, most of these are above. Every other one is above 25%. So you can look at that next year as a consolidation year. Consolidation years are, so-so years sometimes. Anything from, a 9.9%, down point to only a gain on the year of 5%. So these were the consolidation years after the 2-year total return was, 25% or better. The good news is this final column over here, the 2-year return after this consolidation year, or as I call it, a setup year. Look at these gains, folks. Average is 46% next 2 years. So all is not lost, right? All is not lost. That's basically what I'm saying. Appreciate the opportunity. Don't be afraid of the opportunity. The folks that are afraid of the opportunity are, in fact, the ones that are hedging and hoping that they time that hedge appropriately. You don't have to worry about opening up a new position in this environment if you know what to expect, anticipate. I've been, beating this drum so far as the outlook for 2022 and how it's just a normal to be expected market operation, absent an exogenous event, of course, which I can't forecast. So it really is as long as you have the appropriate psychology, outlook, you can take your drawdowns with a grain of salt, so to speak. You can execute and buy dips, confident that this is normal. The market will eventually revert to the upside. And I'm not saying that upside is going to be this year. My outlook has been and remains, at least through the end of this quarter into the third quarter, a wide trading range of 4,100 and change to 4,600 and change. And so far, that has been the case. We broke a little bit above 4,600. And of course, the downside, or the low of the year, is 4,114 in the S&P. April stinks so far, right? We're down for the month of April right now. We're up for the week, slightly. We're slightly positive on the week, not, counting today. But for the month, it's just not working. This is the seasonal returns for the S&P 500, for the Dow, for the NASDAQ, for the Russell, going all the way back to 2001. And usually, we kind of trough here on the 5th trading day, at least for the Russell and all of the indices. And then we make our way up, but that just hasn't worked out. So just like a lot of our other quantitative studies that really aren't bearing fruit, the lower probability returns are actually coming to fruition here this year more often than the higher probabilities on a lot of those studies that we look at every single week. So if you've leaned into the higher probabilities, hasn't been so great. It hasn't been so great this year. It happens. But as a discipline, when we look at studies like this one here that we looked at last week, didn't come to fruition, right? The week before Easter, usually the percent positivity rate, the market is up 63% of the time. But were we up last week? No, we had a big drawdown in the all the major averages last week. It just hasn't worked out. We had a better than 50-50 chance of the market being positive last week, and it didn't happen, so to speak. All right, but here's one for this week. All right, so there's one every week, as you know. We're always looking at the quantitative data, the quantitative studies. This is from an OG, as you call him, the original gangster of quantitative analysis, Wayne Whaley. And this is about when the S&P 500 is down in the week of April 11 through the 18th, so that's last week. When it's down, the next week, the market is usually higher. Why were we down last week? You could make the argument that it was folks needing to raise capital for their capital gains taxes, right? It happens quite frequently, actually. And especially if the S&P 500 was up 20% or greater in the year before, right? That's a lot of capital gains tax. And we were up 28% last year on a total return basis. So it qualifies. Usually tax week, the market is down. But when it's down that week, the 11th through the 18th, the next week is almost always higher. Let me see, this goes back 50 years, this study by Wayne Whaley. Only 14 times was the market down this week if, again, the previous week, the market was down. So it was up 14 times this current week after a down prior week, only down 3 times. The average return was 1.25%. Again, coming into the day, we were up. So we'll see where we finish by the end of today's trading session, and of course by tomorrow, the end of the week, but it's very favorable. Up 14 out of the 17 times. We were only down 3 of those occasions. More importantly, when you look at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, in the last 11 times this has signaled, the market's been up. 11 years in a row when we've had this signal fire. So we shall see. Again, I ask the question, why are people hedging? We know that so far this year has been a bit treacherous. Unfortunately, this is what most people think of. When the market, it doesn't matter when the market's going down. This is the automatic go-to. 2000, 2001, 2002. This is the S&P 500 returns. Most traders, I wish it was just a few, but most investors and trader fear is found anchored in the 2000 to 2002 period. Most traders correlate all risk to this period, given it was the only 3-year decline since the 1940s. If you're not able to recognize that period, this one right here, was actually a generational opportunity versus generational risk, you may be approaching investing in the markets in the wrong way. This was huge opportunity. From 2003 up until late 2007, the market had a fantastic cyclical bull rally. This was huge opportunity. Don't get me wrong, 3 years, 36 months, it sounds like a long time. It feels like a long time, but you've got to be able to appreciate it for the opportunity it presents, not being fearful of it. If you approach your market investing and trading regimen with this front of mind constantly, you'll never be able to outperform the market on a consistent basis. And more than likely, you're going to be underperforming on a very consistent basis. Don't find your sentiment and your psychology affixed to this time period with everything you do and all the headlines that you see on the financial media outlets. Okay, this chart here, we talked about in the trading room with our Finom group members earlier this week. What I'm highlighting in this chart with the arrows, back in 2020, right, we had a nice rally going into the end of the year, but towards the end of the year and around the election, we had this nice corrective wave here, or consolidation period, where each time we basically found support at the former peak, right? And this consolidation was happening above this upward sloping 200-day moving average, right? The long-term trend, the 200-day moving average. Now, if we fast forward to today, we can see, here was a recent trough. We found support there, but then we broke through. What else do you recognize? A lot of this consolidation is happening below the 200-day moving average. In terms of, Seth, you had said that you don't think the lows are in for the year. They may be in for the first half of the year, but you said they may not be in for the whole of the year. And I hold to that. One of the reasons I hold to that is because of this pattern here. And because if the index is having a lot of consolidation below the 200-day moving average, that essentially validates that too many stocks, far too many stocks are trading below their 200-day moving average. They're in a downtrend. Put it all together, essentially we're saying that the market's vulnerable. It's vulnerable to shocks at this time. This could be a false breakdown. It could be. Just as easily as, remember the time that we got outside of the volatility box and above 4,600 on a closing basis, which is good. You want to see that happen, but that could have been a false break out to the upside. We won't know without seeing how things develop over time. We have the potential of either a false breakdown or a false breakout to the upside. We'll find out with more information and more time. Right now, it's open to speculation. I would err on the side of caution simply because, and again, too many stocks are trading below their 200-day moving average, and a lot of this consolidation is happening below the 200-day moving average. Very different from this time period. And just like I said, that wide trading range, 4114 to 4600, Credit Suisse basically of the same mindset. This is their notes from today. You can read them at your leisure, but it essentially says, wide trading range, be domestically allocated, own U.S. equities. They don't believe that international equities are going to do as well as our domestic markets. We're going to debunk some myths here today, as we also often do on the weekly State of the Market. One of those myths, and you probably have heard this many a time on social media, that the Fed's printing press devalues or debases the dollar, right? QE, the quantitative easing, the Fed printing money, the central bank printing money just kills the dollar. But the reality is completely different, folks. Again, people use the the Fed as a punching bag, an excuse as to why they didn't do so well in the market, why they, decided not to participate, and how this is a house of cards. It's all going to come crumbling down. The Fed is the enemy. The reality, this is the chart of the dollar. Look, this was when quantitative easing started. And look how the dollar has performed ever since, right? This is clearly not a picture of the Fed during quantitative easing, which also kicked off again in 2020. You don't see debasement of the dollar here. You see the dollar trending higher. Again, a lot of the stuff that you hear out there really isn't rooted in fact. All you got to do is a little bit of work to go see for yourself. But with that being said, right, because the dollar hit 101. I mean, we're at more than a decade high on the dollar. The last time we got to 101 up here, you have to go all the way back to, the turn of the century, basically. So the stronger dollar doesn't actually bode well for, corporate earnings. It hits their bottom line. 41% of the S&P 500 earnings, or revenues, I should say, comes from overseas, right? So you get hit with that strong dollar, that repatriation, if you will. There are some sectors, and again, no wonder, utilities are doing well. They don't have any, international exposure. But you know who does? Technology, right? If you think about Apple, if you think about Amazon, if you think about some of these big mega cap names, they have a lot of international exposure. The technology sector has a lot of international exposure, and they get hit with that foreign exchange headwind, if you will, from the strong dollar. What's doing poorly this year? Technology, right? Consumer staples, they also tend to have very little international exposure. What's doing well this year? Consumer staples. Healthcare is completely domestic, right? Humana, United Health, healthcare sector has been outperforming this year. So the strong dollar, not so great for that information technology, that growth component of the S&P 500 or NASDAQ. Speaking of information technology, speaking of the NASDAQ, this chart right here from DataTrack, this is fantastic, right? Because the NASDAQ is the worst performing index year to date. It is a growth index. The main constituents are healthcare, i.e. biotech, as well as technology, right? So it's getting hit the hardest from all different fronts, whether it's higher rates or the strong dollar. You just can't get out of the way. Having said that, what you see on the chart here, these are peaks in the NASDAQ, right? So you get this big boom in the NASDAQ. And coming out of the recent recession, that was the leader. But then you get this consolidation, pretty much back to the zero line, if you will. This 252-day rate of change consolidates those gains. But what I want you to focus on is what happens after that consolidation, right? Huge consolidation here, gains. This peak right here, get back to the zero line basically, and gains thereafter. The only time that you had to wait, a goodly amount of time was during the dot-com bust. That was the only time whereby if you didn't buy this consolidation, you didn't get rewarded. Again, big spike, we get back to the zero line. This is a recession. It wasn't a dot-com bust. It was a great financial crisis. But even if you bought that, boom, back to the zero line, boom, right out of the pandemic recession. And now we're consolidating. So if history repeats, you want to buy this consolidation. You want to buy this consolidation. You want to buy this consolidation, and this consolidation today. We are essentially flat to down on a 1-year basis in the NASDAQ as of this week. Returns look good going forward, i.e. setup year have cash on the sidelines. It is your friend. During our weekly research reports recently, as well as in the trading room, we've highlighted the fact that cyclicals like transports have been underperforming utilities. This was from 2 weeks ago, since we had off on Easter Sunday. As you can see, transport's just plunging, right? Now, what we noted in our weekly research report, I say here at the bottom, and this is an excerpt from the weekly research report, for now, it wouldn't be altogether surprising to see a relief reversal of the technical dynamic above in the interim, and given the extremes in the stochastic levels at the end of the week. I mean, look at the MACD all the way down here. Look at the average true range, on this pretty sizable uptrend here. And look at the RSI at 24. And so transports relative performance to the utilities. Now fast forward to, as of April 20th, look at the relief rally we're getting, folks. Now transports are outperforming utilities. Is this a trend? No. I mean, we're talking about a week and a half. It needs more time, right? Because this is time. This is a trend where transports are underperforming utilities basically since November of last year. That's time. That's a trend. This could be just an oversold relative performance here. And it could revert again, right? Because we did it here. We reverted to the upside, transports outperforming utilities, but then rolled over. So we're monitoring. You have to just continue to monitor. Now, transports are associated with Dow theory, right? As the Dow transports, if they're hitting new highs, the Dow's hitting new highs, you have a positive correlation known as Dow theory. Now, if one index is hitting new highs, but the other one's not confirming it, if the Dow hits new highs, but the Dow transports don't, then you essentially have a negative signal from Dow theory. And people associate that with the potential of a recession in the near term. The reality is Dow theory doesn't work. It doesn't. Well, why do I hear so many people talk about it? These folks that have hundreds of thousands of followers. I hear it on CNBC. I hear it on Bloomberg. Why is it, so often referenced? Because I swear to, and I'll show you in the charts here, that's the only answer. Charles Dow developed this Dow theory, decades and decades and decades ago. But the reality is it holds no significant signal so far as future Dow or S&P 500 returns, let alone a recession. Here's all the times that the Dow theory has signaled, basically since 1978. It signaled here. We didn't have a recession until 1980, 81. So signaled in 78, it wasn't until 81 we had a recession. Here, it's happened twice during a recession, but look at this. Here in maybe 84, 86, 87. We didn't have a recession until 1990. These are 1, 2, 3 false signals, if it is a signal at all of a recession. Here's another big signal. In 1995, did we have a recession? No, we didn't have. Here's another time in 98, 99. We didn't have a recession until 2001. So that's 1, 2, 3, 4, 5, 6 total signals, no recession. These happened during a recession here in 2008, then in 2011, or that's actually 2012, maybe that's 2016, another one in 2018, no recession until 2020. So you got 9 signals here, no recession. That's just, come on. Now, what about S&P 500 bear market signals, right, from Dow theory? Again, same dates, folks. Did we have a bear market in 83? No. We started a new bull market in 1982, and that didn't give way until like 1986. Another one in 1987, we didn't have a bear market until right there, 1990. Here's a signal here, and you can see the distance, right? And again, 1, 2, 3 signals, no bear market until 2020. There's Dow theory holds no real value to you as an investor or trader. Doesn't offer you a signal for a bear market, doesn't offer you a signal for a recession. And again, why do so many people swear by it, reference it? Because that guy did. I mean, it's right before you, folks. All right, so speaking of the Dow industrials and industrial, we talked about technology. This chart right here is really interesting, right? Because technology is getting beat to crap. The NASDAQ's getting beat to crap. But when you look at the industrial production of high-tech equipment, look at all of these, folks. I mean, apparently, we still need semiconductors. We still need communications equipment. We still need computers and peripherals for computers, because the industrial production of this technology, of this equipment, of this hardware is still in a strong uptrend, especially computer peripherals. You pair this with the insider transactions, right? The insiders, the CEOs, the CFOs, the executives at these technology companies, which are buying their own stock. And you got to say to yourself, why am I not? Yes, I know the NASDAQ. I know technology. I know fan mag stocks are under pressure and have been all year, actually since late last year. That's value, folks. Given the fact that industrial production says there's huge demand still out there. There's demand. Where there's demand, there's revenues. As long as you can manage that profit margin, you should see those earnings climb in the future. All right, we know that the Fed is tightening rates, kind of switching subjects here real quick. We know they're tightening, and we know that the soft landing that they're trying to achieve, what's a soft landing? Soft landing refers to the economy. You know, essentially you have either a hard landing from a rate hike regime, tightening monetary policy, or you have a soft landing where, you know, things slow, economic growth slows, but we don't tilt into a recession. In a hard landing, things slow rapidly and can push you into a recession. That's a hard landing. That's what the Fed wants to avoid, is the hard landing. It wants to get the soft landing. Unfortunately, and why so many people, the pundits of the Federal Reserve, why they say it's unlikely is because historically it's a low probability to achieve a soft landing, slower growth during a rate hiking regime. We've only had a soft landing 1, 2, 3 times. We've had 10 recessions, though, which would be the hard landing. So 13 rate hike cycles, only 3 soft landings, basically, since 1955. We'll see. Last time the Fed managed to engineer soft landing was in 1994. The odds of a recession over the next 12 months are actually still pretty low, looking at this Bloomberg survey here, even though, and I know a lot of you may have heard the chief economist from Goldman Sachs say that he anticipates a recession within the next 2 years. He assigns a probability of that recession at 35%. Just so you know, folks, the 35% level is kind of the default level that these economists and strategists refer to so far as a high probability of a recession. Historically, 30 to 40% is actually, while it's less than 50-50, it's at the high end of the probability for a recession. But so far as that's 2 years that the Goldman Sachs economist is looking out for a recession. He gives it a 35% chance over the next 2 years. He does not see the risk of a recession here in 2022. The Citi U.S. Economic Surprise Index, I mean, look at it, folks. I mean, here's the zero line. And what does this reference, the Citi Economic Surprise Index? So every week we get a bunch of economic data. Every day of every week we get a bunch of economic data. And if the data comes in better than the economist forecast, you see ticks higher. The darker, well, the dotted line here is this year, 2022. You can see it's well above average. Most of the time, the lines are just above or just below the zero line. This is well above. The only time it's been higher is briefly in 2018, and of course in 2020, coming out of the economic lockdown, because nobody knew how to model for a post-pandemic self-induced recession. So that's why this is, ridiculous. But this in a normalized economy is still very high, telling you that, the economic data that's coming out on a daily, weekly basis is beating economist estimates at a pretty steady clip. It's not recessionary, right? So we've frequently talked about the yield curve inverting, right? Because that's also a signal of a recession, potential recession. But as I've said before, for a clear yield curve recession signal ahead, greater than 50% of yield curves historically need to invert over a period of a few months. As of Monday, so coming into this week, as of Monday, we only had 14% of the yield curves inverted. We need greater than 50% to fire a true recessionary signal. The other thing that makes this economic period quite unique is households' balance sheets are in the best shape in like 40, 50 years, folks. They're in the best shape. Oh yeah, well, debt keeps going higher. Yeah, it's not the size of the debt that matters. It's the serviceability of the debt. And so we look at personal savings rate. We look at cash deposits versus that debt that's being accrued for the average household. And so this chart over here, as you can see, the net debt is actually at the lowest level. It's negative with respect to cash and total debt. So, I mean, the households are on this fantastic, look at household net debt to nominal GDP ratio, negative. You wonder why retail sales continue to move higher, right? This is Johnson's Red Book retail sales. Now, this is not even my expectation. I was expecting this slowdown to persist and to eventually have single-digit, healthy, but single-digit year-over-year retail sales growth. All of a sudden, we reaccelerate. Now, one of the reasons is not just because the households have a better balance sheet. Another factor is higher wages. Oh yeah, but the inflation is offsetting those higher wages. In fact, the higher wages aren't keeping up with inflation. I'll get to that in a moment, right? Because that's what we hear a lot. But higher wages are a component. The other thing is we're getting higher tax refunds. On a year-over-year basis, as of last week, the average tax return is almost 10% higher than the previous tax season. And what are people doing with that? Obviously, they're spending. I mean, we've had a nice acceleration here in April of Johnson Red Book retail sales. All right, inflation. Okay, so let's assume that you're being paid $100,000 a year. Make the numbers whatever you want, all right? But you're a saver, okay? So whatever you're making, there's a certain amount that you are capable of putting into your savings account, meaning that you're not living paycheck to paycheck. And I respect the fact that many Americans are in that situation, just as I respect the fact that many Americans aren't. They are able to save. There's leftover, if you will. So let's assume that you're being paid $100,000 a year after taxes, and you spend $50,000 a year on whatever, okay? Goods, services, debt liabilities, etc. If inflation hits 10%, let's say inflation hits 10% over the next year, your basket of goods, remember you're spending $50,000, so your basket of goods after the 10% inflation now costs you $55,000, right? 10% times 50,000 gets you to 55,000. Inflation. How much does your salary have to go up to offset this, right? Wage inflation. How much more do you have to make to offset this 10% inflation on the goods and services that you spend throughout the year? Is it 10% also? Because inflation went up 10%, does your salary have to go up 10%? No. It only takes 5%, right? If you're making $100,000 a year, your spending went up 5,000. 5% times 100,000 gets you that $5,000. And you're back to break even. You don't need to keep pace with inflation. This is half the rate of inflation. And so basically this example demonstrates why, any percent increase in inflation does not need to be met with the same percent increase in your pay. But you don't hear this in the financial media, right? They don't go through this mathematical exercise. Most math people think in linear terms. A plus B equals C. They don't think geometrically because our minds just don't work that way. But this is the reality. So again, why are consumers able to spend when all we hear in the financial media is that wage inflation is not keeping up with the consumer price index or consumer goods inflation? It doesn't have to. It doesn't have to. Their math is not being done properly. All right, let's take one last peek, see where we are in the market. Hopefully we're in a little bit better shape before we end our state of the market. We are not. We are in much worse shape, actually. Probably a good enough time to say thank you for joining me here on our weekly state of the market. Maybe we'll have a better Friday, a turnaround Friday, and I'll see you next week here with Finom Group.